Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. Eric, depreciation and amortization, not words that you often hear in a normal conversation. What are they? What's the difference? How can they be used?
Yeah. This is a question, right? And we'll see this all the time when we're walking through our clients through their P&Ls. Yeah.
Really? Like it just comes up? Like you guys are bringing it up as something, or it's part of the conversation?
It's part of the conversation. So, we're going through the lines and we're talking about, sales and cost of goods, goods sold. And then we get down to the, some operating expenses and the non-operating expenses. And then everybody's like, well, what's depreciation? What's this number? Where did you get that number from? And then they're like, amortization. What is that? And where'd you get that number from?
I definitely feel like I fall into this category.
Yeah. So we want to just, again, provide some knowledge and understanding around how are these two, how do they come up? How do we calculate them? And where does that number actually come from?
Hit me. Let's start with depreciation.
Yeah. Depreciation is the easy one, right? So
love that.
A little bit simpler of a concept. So, we're a business, right? And we buy tangible assets. Tangible assets being furnitures, fixtures, equipment. Maybe we did some improvements inside of our building, or maybe it's the building itself. So all these tangible items lose value over time. They depreciate. So the IRS sets certain guidelines, whether it's 3-year, 5-year, 7-year, 15-year, or, like buildings, 39-year life depreciation. And then there's certain methods in between there. We're not going to get into that. So essentially they set all these rules on what gets depreciated how. And then we're tracking that and recording that on your books every month.
Okay.
And that's depreciation expense. Now you might see something that pops up called, say, Section 179 depreciation. Now that is a election that we make for tax purposes to take more than that allowable schedule. So certain assets fall within, qualifying for Section 179. You might hear things like there's certain vehicles that you can buy that can qualify for that. But that's just a tax election we're making to use more than the normal schedule of depreciation. A lot of times 100% of that asset value.
Okay. And that's to adjust your bracket and such, right?
Exactly. Right. We want more deductions this year. We want to accelerate deductions to get them, because this year we knew we know where we are at from a profit standpoint. Next year is always uncertain, and we need that, right? We're in a healthy enough tax bracket where it makes sense to accelerate deductions.
Okay, fair enough.
So yeah, again, that number is going to come from your accountant. So when you buy a new piece of asset, maybe you buy a $30,000 piece of equipment, you need to let your accountant know so they can do the calculation. So you can adjust your depreciation number, because these are one of the things that we do when we do our monthly planning with client, or when we do a monthly bookkeeping with clients. We can have really good detailed tax plans that are a lot more accurate because we are accounting for all these equipment purchases. If you're not accounting for that, then you're missing a huge part of your whole tax realm.
Well, and as you're saying, you're doing that every month. All of a sudden, if you're not keeping track of when you bought it, you can't track of how many months that you can take advantage of that depreciation.
Exactly. And you might actually run into some issues that we see often. I bought a piece of equipment. Maybe it's a $50,000 piece of equipment, and I'm just expensing my payments on that. So maybe 6 months through the year, I've paid $5,000 in payments. Well, I'm getting a $5,000 deduction, but if I accounted for that correctly, so I recorded the $50,000 asset and the $50,000 liability for making those payments, well, then I can go and I can accelerate depreciation on that $50,000 asset, get all the credit for it this year, instead of writing off the payments where you only got a credit for maybe $5,000. One of the most accounting errors that we see on DIY books. That's a huge benefit.
Okay. So let's get into amortization then.
Yep.
Okay. That is the other side of the coin. So I'm assuming this is the stuff that doesn't exist in this physical world that I can't touch it.
Yeah. So amortization is the deduction of intangible assets. So
What's an intangible?
Tangible assets, right? It's nothing, right? We don't have paper. We don't have anything to touch with it. Well, maybe we probably have some paper because usually it's based on some type of agreement.
It becomes something on paper, right?
Yep. So the number one would probably be goodwill. That's what we see most often. And goodwill is the value of a business above and beyond the tangible assets that it has. So in tax world, you get goodwill by purchasing it. So I go out and I buy an accounting firm, right? Say we buy an accounting firm for $1 million.
Okay.
Accounting firms don't really have a whole lot of value in furniture, fixtures, and equipment, right? We might have some computers, but used furniture, don't carry a lot of value in it. But what carries a lot of value is the people, processes, procedures, client lists, all that fun stuff. That actually carries a lot of value. So in an accounting firm purchase for $1 million, we might only have $50,000 of depreciable tangible assets. And we probably have $950,000 of goodwill. And that goodwill then is amortized over 15 years is the IRS standard for goodwill. Or unless we completely exit all those assets out of the business, those intangible assets out of the business.
Eric, give me some quick examples of something that you guys would amortize here.
Yeah, when we acquire an accounting firm, the goodwill.
But like, let's break that down. Like because we're big on processes and systems here.
Yep.
So how does that kind of work? What does that look like? Like, we've decided to get rid of using this and built a process for it. What does that kind of look like when you're amortizing?
Yeah. So amortizing rules are kind of tricky where essentially if I'm buying a whole sect of goodwill from another business when we acquire it, I am bound I cannot break that down into individual components that comprise that whole goodwill. So unless you could, if you specifically spell it out when you acquire that business and there are specific identifiable values attributable to different intangible assets.
So for example, let's say I bought Dr. Pepper and I somehow got their magical formula on how to make that specific drink. Would that possibly be one?
Yeah. So you would have a breakdown of things like, say, patents. There's going to be some probably very expensive non-competes in there and values attributed to those non-competes. Then you're going to have just goodwill, right? And goodwill is bound by those specific rules. But now we have for simplicity's sake, we have three different intangible assets. Say patent, 15-year amortization on a patent, it expires in 3 years. We have to go and repurchase it, or we have to go and reapply for a patent, incur the costs for that. Right now that can be written off and we have the new patent in place, which is now amortized again over 15 years. Non-competes could probably work the same way. Again, if they expire prior to the amortization, again, a lot of those rules get very nuanced and really have to be evaluated on a case-by-case basis, depending on how your non-compete agreement is written and depending on how all the contracts and everything are written. And so that part is very nuanced. And that's why if you are buying a business, do not let your accountant know about that after the fact, because one of the most, it can be a significantly material item to negotiate in the acquisition of the business is your asset allocation, because that tells us what tax attributes that we attribute to you buying that business. So you buy a $5 million business and they said, hey, we're going to put this all to land. Well, land's not deductible. So now we just shelled out $5 million for something we get no tax benefits for until we completely exit the business. Whereas if we come in during that and we say, well, you just sign, instead of you signing this, like this is a terrible offer. Let's break this down. We think there's $3 million of equipment. There's $1 million of goodwill. There is $100,000 in land and $900,000 in the building. Well, that $3 million in equipment we can write off in year one if we wanted. The $2 million, maybe I have some of those depreciation rules not completely right. There are limits to accelerating depreciation, but for simplicity's sake, let's say we can write off that $3 million at once. We can depreciate the building over 39 years. We can depreciate some other things over 15 years. But if we're not paying attention to how that's structured, we can lose out on deductions or and the theory is a deduction today is worth significantly more than a deduction tomorrow or unknown in the future.
Well, let me as we kind of wrap this one up, I always want to know what you've seen, because you've seen a lot of other people's taxes.
Yep.
Got one that kind of comes to mind when we talk about amortization, depreciation, something that you've seen where you're like, I can't believe this got missed.
Definitely. So, well, the examples obviously we see all the time of assets being missed. That are they just account for the expenses and they don't actually add the asset
and that could
depreciate
be
it.
Literally anything, right?
Yep.
Like any physical item
that you purchase.
Are really easy to track, by the way.
Yep. In a future episode, we'll go through some case studies in particular that we have, and we have some examples of these with the actual dollars attributed to it. But that's 100% something we see on a regular basis. Other times we'll see things like, hey, somebody did a remodel of a building and they didn't break it down between qualified improvement property, which has much better depreciation attributes than, say, standard leasehold improvements or even the building itself. You might be looking at a 39-year depreciation versus a 15-year, and 15-year we can do some tricks on to accelerate that depreciation. So it's very important to work through all these nuances, right? You could be saving a lot more money on tax if you just do a little planning around it.
Well, and one last thing, because I think this will really hit home. Would you say depreciation and amortization is more the long-term game?
I think it needs to be strategic. I think it's a strategic piece of your tax puzzle.
So would you say then you could actually still get more tax benefit from these than just writing off the initial purchase?
Correct.
That's something to think about then.
Awesome.
Perfect. Thank you very much, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.